All right, good afternoon, guys. I decided to do this special market update video because I've been receiving quite a few questions from you guys asking whether the market is overextended. And we've seen if earning seasons right now of a lot of companies, stocks are actually popping. So, like most recently, right, what we actually saw just last night, Meta and Microsoft reported their earnings and they actually popped very well despite them being actually in a little bit overvalued territory. So what this special market update is for me to share with you, are we actually in a euphoria mood right now? So you can see right now is in this image, right, is the stages of a stock market bubble. So right now you can see, especially after what happened in April, right, with the price running up and recovering very quickly, people are concerned. Are we in overvalued territory now? So what we are going to go through today is we're going to take a look at the actual data, both the short term and long term, to understand what we can do. And I'll share with you my thoughts on the current market now and especially how you can position yourself. Now, before we begin, just the usual disclaimer, right? Everything that we share here is for information and educational purposes only and does not constitute financial advice. Okay, now, so this is the earnings that we've seen. Meta and Microsoft just reported last night. Very, very good results. Earnings are blowing past expectations. And Google just reported a few days ago. And they also did very well after the market closed. So that's a sign of near-term optimism. And let's take a look at how they actually fare. So you can see for Meta and Microsoft, right, I took this screenshot just this morning. Meta is up 11% this morning and Microsoft is up about 8%. So very, very impressive. Even though just before they reported the earnings, people are already concerned that they're expensive and now they have become even more expensive. Now let's look at some data, right? This is the S&P change in forward 12 months earnings per share versus the change in price for 10 years. Okay, so you can see how there is that rise in the forward 12 months EPS and how the price has significantly outpaced the expected profits, a divergence that increased valuation risk if the earnings disappoint. So example, right, let's take a look right now. You can see that this period was when the Trump, back in April, right, when Trump announced tariffs, and you can see that there was a retrace all the way back down to this, what we call the median line. And right now, after recovery, we have kind of like extended all the way up again. And if you look at history, right, when was the last time that it was above the line? It was actually during the whole 2020 period right over here. And even then, the gap wasn't as big as what we see now. Okay, now let's look at more data. This is another one, the S&P 500 index, the forward 12 months P ratio. And what from Bloomberg, and you can see that stock valuations are at levels rarely seen since COVID days. Again, this was when the Trump tariffs happened back in April, and right now it has recovered. And now there's this concern right now again that we are in like peak valuation since COVID days. Here are some top stories, right? If you just Google the news, about this kind of news, these are the first stories that you'll see from CNBC. And what are people saying? Investors are using borrowed money to buy stocks. U.S. stock market bubble. 5 signs of a market bubble. Stocks of a bubble. So this is what the media are saying right now. But you know, as investors, right, we don't want to just take into account what the media is saying. Why? Let me explain. Because you must understand, right, mainstream media, what is their goal? Ask yourself, what is the goal of reading the newspaper, right? What catches your attention? It is those eye-grabbing headlines that catches your attention. So you must understand, right, the goal of a media, their job is to capture attention. So what captures attention? These kind of terms captures attention. But does it actually mean that a stock market bubble is here, is coming? That's not necessarily true. That's the reason why we must also look at historical data to give us and see a much bigger picture. Now, fear and greed index, you can see this is what the market is saying about it now. Right now, we used to be in fear and right now we're in greed territory. And this is a survey that's being done with a few investors, right? This is what we call the AAII survey. So what does this sentiment survey does, right? It's a sentiment survey, a weekly one conducted by this association that gauges the sentiment of members toward the stock market direction over the next 6 months. So they can choose to be bullish optimistic, or they can choose to be bearish, which is pessimistic, depending on market prospects. So you can see, right, what is happening now. So you can see at the start of July, people were mainly more bullish, right? And as the weeks goes by, this is as of 23rd July, right? You can see the bullish sentiments has kind of dropped. So more people are starting to be a little bit more neutral. So not really bearish as well. More people start to become neutral. So these kinds of tell you something, right? More people being scared of the market now. Is the fear and greed index a good indication of how the market is seeing? Not necessarily true. Because if you look at the historical average, right now in terms of the sentiment votes, right, we are roughly in the historical average right now, including the neutral and the bearish part of things. Okay, and I'm sure that everyone is concerned and just thinking Trump will screw the stock market. Trump is he's not smart. He's trying to ruin the whole stock market. But let's just understand this a little bit more. Right? Let's just look at Trump and understand what he's trying to do. Now, this is another interesting thing which I found online, which is that there is this study that's being done, right, that August has a reputation for being weak during second-term presidencies. So this is a pattern. It does not mean that it's 100% will happen, but it's a pattern, right? And if you look at how the pattern is, it's very interesting. Now look at Eisenhower second term, right? S&P was negative. During during August, just August, Nixon second term, negative. Reagan second term, also negative. It dropped by 1.2%. Clinton second term, negative. George W. Bush, negative. Obama second term in August, also negative. So now we are in Trump's second term. So now the question is, okay, will we follow this pattern and we'll see the S&P in August alone? Will it be negative or not? Of course, based on this pattern, it might be. So this is that short-term thing that might make people a bit concerned, right? That looking at this history. Now, another thing is we know how Trump has been talking about doing the tariffs, how he has been pushing the Federal Reserve Chairman, Jerome Powell, to reduce the interest rates. Now the interest rate is about 4%. He wants Jerome Powell to reduce all the way to 1%, cut 3% straight away, like a immediate cut. And why he wants to do that? Because he wants to make people to support consumer activity. He wants to keep the economy growing, because when there's interest rate is lower, money is cheaper to borrow, right? People will actually take the money, they will invest, they will buy more and things like that. So that is why when there's rate cuts, right, why he wants rate cuts is he wants to boost the market economy and it improves market sentiments, because with more money to invest, business will do well. Business do well, there'll be more profits to invest back into the business. So that's the reason why. But what happened just last night? Even after Trump pressuring Jerome Powell, the Fed holds interest rates steady. It is still at 4.2 to 4.5%, no change. And so you can see, and why did they maintain steady? Because they say the inflation is still very stubborn because of tariffs, right? And labor markets is still solid. So you can see how the Federal Reserve, right, they are not getting strong by Trump, and Trump, we don't know how Trump will react, okay? But then this is the reason of the interest rate now that is still very high at 4%. And when it's high interest rate, it means what? It means that it's hard to borrow money, right? Hard to borrow money, hard to invest in business. And the idea is that profits might there be a cap to the profits, right, for different businesses. Again, it's not across all businesses. It might be to consumer staples. As tariffs impact, it might be more expensive. That is why. But talking about the tariffs, right, what are we seeing now? A lot of deals are being made across the world. United States and Europe reach a deal. China and US, they talk of extending, but there's no updates yet. And also, most recently, I think just yesterday, there's a deal with South Korea featuring 15% tariff rate. So a lot of deals are coming in, which are positive signs, right, to the market, because there's lesser uncertainty. But it's also very important for us to see. These are all the short-term things, right? But what does the bigger picture say? Right, because you realize what we've been seeing now is all the short-term things. Example, what's going to happen in August? What are the trade deals happening now? What are the interest rates right now? So that's why, as investors, we want to look at the longer-term picture. And I want to share with you this index, right? This indicator called the Leading Economy Index that is shared by this research house called Carson Research. So this Leading Economy Indicator Index, right, tracks a composite of indicators. For example, housing, consumer spending, and manufacturing. So they are designed to use all these macro data to put together and flag turning points before they show up in GDP. So just example, right, like the consumer-related data, they actually show unemployment, benefits claim, vehicle sales, housing includes like building permits and new home sales. So they really consolidate all these 20 components, right, and look at how the economy is doing. So you can see, right, how this leading economy indicator, right, index, right, has actually shown whether the economy is growing below trend or above trend. So if you can see them below trend, right, example like this portion when it's below trend, this is when the recession happens. Again, below trend recession happens. In 08, recession trend below happened, and this is COVID again. And right now you can see we are at this stage, right? That when it's below, it means that economy growth is slowing. It's not like very drastic, but it's slowing. But is this a concern? Because if you look at history, right, this has happened quite a few times before based on this indicator, right? Example of where I'm highlighting right now. So does it mean that we are going into a recession? No, that does not imply based on where we are now. But it just shows that the economy is probably slowing down. Okay, so and in fact it shows that we are probably in a cooling phase, not really in a crisis. And in the past 3 years, this what we call the LEI lah, okay, the short form is that it has not pointed to any recession, even though at 2022 it was a bit on the higher side. But right now, right, it still doesn't point to a recession. Now, another interesting data, right, also shared by Carson Investment Research. So what you can see, right, is that this is a data that they did of the S&P performance after 60 days above the 20 MA line, which is a technical indicator. And this is since 1950. So we have 74 years of data. So you can see, right, in the S&P future returns after 60 days above, that means the S&P has been 60 days above the EMA, right? In the whole, let's look at the 6 months and 12 months, most of the time, S&P has turned out positive. 12 months, it has turned out positive, except this back in 1965, where 12 months it was down. But after preceding that, right, from 1971 all the way until 1998, right, you can see that in the 12 months period, take a look at the 12 months, after 60 days above, in the 12 months period after that, it all went up by above 20%. And right now, where we are right now is that we have also break above that 60 days, 20 days MA right now. Right, so where are we going to be in 1 month, 3 months, 6 months, 12 months? We are not sure. Right, but based on how pattern is, right, it seems like we will probably go higher in the next 12 months as well. Okay, so what basically this means is that, okay, the market should still move in a positive trend, and tying in with what you saw in the recession, the LEI earlier, right, that we are not in that alarming rate that we are in a recession, because the economy indicators that we are seeing are still looking fine. Okay, so these are the longer term picture, but let's continue looking at more data. Right? Now, this is also another chart that shows all the whole S&P price, regardless of whoever is in the White House office, and this is based on since 1900s. So you can see that regardless whether it's the Democrat, whether it's the Republican, what do you notice in the long run? At the end of the day, the stock price goes up. Right, that whether there's any policies come in, like Trump, this is his second term, right? During his first term, he came in, he also introduced the tariffs, but at the end of the day, the stock market still ran up, right? And now it's his second term, he's introducing these tariffs again, but what are we seeing? At the end of the day, the stock market still goes up, whoever is in the White House. So now we are looking at the longer term picture again. Now, let's look again. Now, you notice this is stocks. Now, let's look at some individual companies and the three that just reported, right? Google, Microsoft, Meta. And you'll see something very, very interesting. So, look at this. Look at the Microsoft stock price as compared to their net income. And you'll kind of see this pattern that the net income, right, and their share price, right, has always moved in tandem together. Can you guys see, right, that the stock price has always moved slightly below the net income? Okay, and at this point, right, back in 2021, it was above, but it's still in line. It follows this trajectory very, very nicely, right? And 2023 and 2024, right now, we are actually, 2024 actually went up a little bit. The price was a bit higher, but at the end of the day, right, it still followed the fundamentals. And this is the latest result as was reported. We are still in line. That means the stock price is still moving in line with the net income. So this is Microsoft. And we look at Google, right? you see a very, very similar picture. There were certain times where it was higher, example this point, but what happened? It actually went back down. At this point, it was higher, and what happened? It went back down. But where are we right now? Are we in the overstretched territory based on their latest earnings? We might not necessarily be, because the price is still moving according to how the fundamentals of the company is growing. Now, Meta, also the same thing, right? You can see it follows the same trajectory as Microsoft and Google. So what does it mean, right, when we look at all of these three data? Is that in the long run, stock price will follow the fundamentals of the company. So this is the long-term earnings trend of the S&P 500 earnings per share, the 12-month rolling, and the trend line for the last 70 years. And you notice, right, even though there's some zigzag up, down, and all right, in the long run, right, it follows the trend line. And of course, in the short term, yes, it might retrace back a little bit, but what's going to happen is that it will still follow the trend line going up. Because the whole idea is this: how will share price performance come? It comes when a company continues to perform, right? As their fundamentals continue to improve and perform. So in conclusion, right, what we are seeing right now is that a lot of the short-term news we are seeing points to some mid-term or short-term volatility that's going to happen, like in the month of April, grid happening, and you know, like what the media is trying to paint you a picture that the short-term is a bit messy. But in the long run, right, you'll notice that the companies, like what we saw earlier, they are actually still moving in track with how the fundamentals are performing. So the thing is this: you want to always look to invest in quality companies that can consistently deliver results and have that good track record, especially in the past 5 to 10 years. And especially now we are in this tariff-sensitive environment, right? Ask yourself, what kinds of industry, what kinds of companies, right, will not be affected by tariffs drastically? I give you a perfect example. Imagine now if there was a tariff on chickens coming into Singapore. What's going to happen to our chicken rice? It's going to be more expensive, right? So these are items that will be directly impacted by tariffs. But again, if let's say there's tariffs on chickens, but let's say you are trying to buy a vegetable, but there's no tariffs on vegetable, will vegetables be affected? Not really, right? So it's the same thing goes when we invest in companies, right? You want to think of industries or companies, right, where their services or their products, right, would not have that direct impact on tariffs. Right, so when you see it from the picture, you realize that actually, right, we are not really in that form of like scary phase where super overvalued, everything is overstandard. In fact, I would say that we are moving according to how the market is moving right now. Okay, so I hope that this has helped you to learn something and take away something here today. Okay, but as always, remember, at the end of the day, you always want to make sure you are investing in high quality companies that can grow your portfolio over the long run, okay? And don't be shaken out by the short-term news, guys, okay? Take the short-term news as a way for you to understand how the market moves and prepare yourself, position yourself. So at the end of the day, in the long term, right, you will still win, okay? I hope that this has helped you today, and if you have any question, feel free to let me know. Cheers.